Welcome to today's Konsults.ai premium briefing, where we deliver a high-impact, data-driven financial analysis of Alibaba's most recent quarterly results. In this episode, we'll dissect key financial metrics, identify critical inflection points, evaluate working capital efficiency, and dive into margin dynamics, all through the lens of rigorous consulting frameworks and Bloomberg-style market insights.
Absolutely, Shekhar. As Alibaba navigates an evolving regulatory landscape and shifting consumer behavior in China's e-commerce sector, investor expectations have never been higher. We'll ground our analysis in precise quarterly figures, comparing trends against historical baselines and peer benchmarks to reveal underlying performance patterns and regime shifts shaping Alibaba's near-term trajectory.
And from a CFO's vantage point, it's essential we don't just look at the numbers in isolation. Alibaba is operating in a tough market, with geopolitical headwinds and increasing competitive pressure. This episode will unpack how those real-world challenges are reflected in the financials, giving investors and strategists practical, actionable insights to navigate what's next for Baba.
Let's start with Alibaba's top line. In the most recent quarter, revenue clocked in at RMB 240 billion, marking a modest 3% decline year-over-year, but a sequential uptick of 2% from the previous quarter. This indicates some stabilization after a challenging macro environment.
Exactly, Shekhar. Digging deeper, the revenue softness primarily stemmed from slower growth in core e-commerce, which was offset partially by the cloud computing segment showing resilience with a 12% year-over-year increase. Compared to peers like JD.com, who reported 5% revenue growth, Alibaba's deceleration signals market saturation and intensified competition.
On the profitability front, EBITDA stood at RMB 70 billion, reflecting a margin of 29%. This represents a 5% year-over-year contraction in absolute EBITDA, driven by increased investments in logistics and AI capabilities. From a consulting standpoint, the margin compression is a classic trade-off when pivoting towards higher growth but capital-intensive segments.
Adding to that, net income declined more sharply to RMB 40 billion, down 8% YoY. The differential impact between EBITDA and net income stems from higher interest expenses and a slightly elevated tax rate this quarter. This signals some financial leverage stress, albeit manageable given their strong balance sheet.
From a CFO perspective, the cash flow statement tells an important story. Operating cash flow held steady at RMB 55 billion sequentially, despite the net income decline. This suggests solid cash conversion and disciplined working capital management, which cushions the P&L volatility.
Good point, Raj. Speaking of the balance sheet, Alibaba ended the quarter with RMB 110 billion in cash and equivalents, maintaining a net debt position close to zero. This robust liquidity provides strategic flexibility amid ongoing regulatory and geopolitical uncertainties.
Looking at quarterly trends, the slight sequential revenue improvement is a positive sign after several quarters of contraction. However, EBITDA margin has compressed by roughly 200 basis points quarter-on-quarter, largely reflecting increased R&D spending. Compared to peers, Alibaba still maintains higher operating margins. JD.com reports around 22% EBITDA margin, underscoring Alibaba's superior scale efficiency.
What strikes me is Alibaba's working capital efficiency, which complements the cash flow stability. Their days sales outstanding and days inventory outstanding remain relatively flat, signaling stable collections and inventory turnover, which are critical given supply chain pressures in the region.
Summarizing, Alibaba's financial health shows resilience in liquidity and cash flow, even as top-line growth moderates and margins face headwinds from strategic investments. The quarter is a classic example of balancing near-term profitability with long-term transformation imperatives.
Exactly. The data suggests we are in a transitional regime for Alibaba's earnings profile, where revenue growth is plateauing, margins are compressing, but cash flow remains solid. This dynamic will be key to monitor going forward, especially against the backdrop of evolving market competition and regulatory environment. When we look at Alibaba's recent quarterly performance, a few clear inflection points emerge that are reshaping the company's trajectory. The most prominent is the regulatory clampdown that began in late 2024, which has fundamentally altered Alibaba's operating environment and led to a regime shift from rapid expansion to more cautious growth.
Absolutely, Priya. From a consulting perspective, these regulatory constraints force Alibaba to recalibrate its growth engines. The company's pivot towards cloud computing and AI investments is a strategic response to this new normal, but it comes with margin pressure and requires patience before payoff. This is a classic case of managing a strategic transformation under tightened external controls.
And don't forget the changing consumer dynamics. China's e-commerce market is reaching maturity, which means slower user-base growth and more price sensitivity. That directly impacts Alibaba's core commerce revenue, putting pressure on top-line growth despite the company's scale and brand power. The strategic pivot to cloud and logistics is necessary, but these are capital-intensive moves that take time to monetize effectively.
Right, Raj. The data supports this shift. Core e-commerce revenue showed a 3% year-over-year decline this quarter, while cloud revenue grew 12%. That divergence signals a fundamental change in the business mix. Moreover, operational metrics like slower revenue growth, combined with increased R&D and SG&A spend, highlight a regime transition from volume-driven profitability to investment-led value creation.
That's key. From a regime change standpoint, Alibaba is navigating a period of margin compression, about 200 basis points this quarter, due to heavier investment in AI and logistics capabilities. This implies a longer-term view on profitability. The consulting takeaway is that investors and management need to recalibrate expectations, focusing on cash flow sustainability and strategic optionality rather than near-term margin expansion.
From the CFO seat, I'd add that working capital and cash flow management become even more critical during such regime shifts. Maintaining liquidity buffers and ensuring efficient cash conversion can provide the runway Alibaba needs to execute its transformation without sacrificing financial stability. Any misstep here could amplify risks, given the volatile regulatory and geopolitical backdrop.
Let's start with the key working capital metrics. Alibaba's Days Sales Outstanding, or DSO, held steady at 45 days this quarter, essentially flat compared to the prior quarter. This indicates consistent receivables collection, which is a positive sign amid slower revenue growth.
Maintaining stable DSO at 45 days during a period of revenue pressure shows disciplined credit management. From a consulting perspective, it suggests Alibaba's customer payment terms are well controlled, limiting risk of cash flow disruptions.
Exactly, Shekhar. On the ground, consistent DSO is critical because any elongation would tie up cash that could otherwise fund investments or pay down liabilities. Especially with Alibaba's push into capital-intensive areas like logistics and AI, keeping receivables in check is non-negotiable.
Moving to Days Inventory Outstanding, Alibaba's DIO ticked up slightly to 38 days from 35 days last quarter. This modest increase reflects higher inventory levels, likely tied to expanded logistics capacity and stocking for new product launches. By contrast, JD.com's DIO is closer to 30 days, signaling more aggressive inventory turnover.
That incremental rise in inventory days is a double-edged sword. On one hand, it supports Alibaba's strategic shift into logistics and supply chain integration, providing greater control and service capability. On the other hand, it temporarily reduces cash conversion efficiency and increases working capital requirements.
Right, and from a CFO's playbook, you want to balance that carefully. Increasing inventory to support growth is sensible, but too much buildup can lead to margin erosion from obsolescence or markdown risk. Alibaba's slight DIO increase is manageable, but should be monitored closely as they scale.
Regarding Days Payables Outstanding, Alibaba extended this metric to 60 days this quarter, up from 57 days previously. This is a strategic move to lengthen supplier payment terms and improve cash retention. For context, JD.com holds payables around 55 days, so Alibaba is slightly more aggressive here.
Extending payables provides Alibaba with a natural source of financing, easing cash flow pressures during this investment phase. However, from a consulting viewpoint, it's important to ensure this doesn't strain supplier relationships, especially given the critical role of logistics partners in Alibaba's transformation.
Absolutely. Pushing payables too far risks supplier pushback or disruptions, which would be costly in the long run. Alibaba's current 60-day DPO strikes a reasonable balance, improving liquidity while maintaining operational agility. This working capital posture underpins their ability to fund growth initiatives without external financing.
Let's dive into Alibaba's margin profile this quarter. Gross margin came in at 45%, down about 150 basis points year over year. This decline primarily reflects increased costs in product sourcing and logistics as the company scales its supply chain integration.
To add precision, operating margin contracted to 18% from 20% in the same quarter last year, a 200 basis point compression. Net margin followed suit, dropping to 16% from 18%, driven by higher R&D expenses and incremental interest costs linked to new capital investments.
From a CFO perspective, that margin compression is expected given Alibaba's deliberate ramp-up in AI and logistics capabilities. These are heavy upfront investments that weigh on profitability in the short term, but are necessary for sustainable competitive advantage.
Exactly, Raj. From a consulting standpoint, this is a classic margin trade-off during strategic transformation. Alibaba is sacrificing some near-term profitability to build long-term value drivers, particularly in cloud and AI, where scale and technology leadership matter.
We should also note pricing power dynamics. Despite the tougher e-commerce market, Alibaba managed to maintain gross merchandise volume with slight price increases in select categories, mitigating margin erosion somewhat. But margin recovery will depend heavily on cost efficiencies and operational leverage.
Cost control is indeed pivotal here. Alibaba's ability to manage fixed costs while scaling new growth segments will dictate margin trajectory. They are optimizing SG&A expenses, but the balance between investing in growth and keeping costs disciplined is delicate.
Furthermore, Alibaba's margin dynamics reveal their strategy execution effectiveness. The gross margin dip signals short-term pressure, but the maintenance of an 18% operating margin shows some cost discipline and efficiency gains elsewhere, like automation in fulfillment centers.
Comparatively, Alibaba still outperforms JD.com, whose operating margins hover around 14%, reflecting Alibaba's scale and operational leverage. This margin cushion provides Alibaba room to invest aggressively without eroding shareholder value excessively.
Looking ahead, margin expansion hinges on successful monetization of AI initiatives and cloud growth, translating into higher revenue per dollar spent. If Alibaba can improve contribution margins in these segments, it will offset ongoing pressure in mature e-commerce areas.
To conclude, the key margin takeaway is that Alibaba is navigating a margin transition phase. Investors need to recalibrate expectations for short-term compression, while recognizing that these investments underpin Alibaba's future profitability and market leadership.
Starting with the risks, Alibaba's regulatory environment remains the most immediate challenge. Despite some easing, there's still uncertainty around antitrust scrutiny and data privacy rules that could impose additional compliance costs or limit certain business activities.
Absolutely, Priya. From a CFO standpoint, regulatory uncertainty forces a conservative capital allocation approach. You can't aggressively expand when rules might shift overnight. It's critical Alibaba maintains strong stakeholder engagement and builds contingency plans to navigate potential clampdowns without disrupting core operations.
Adding to that, the market saturation in China's e-commerce sector is a structural headwind. Alibaba's core commerce growth is plateauing, which means the company must innovate beyond traditional retail. Their strategic pivot to cloud computing and AI isn't just a growth lever, it's a necessary evolution to offset diminishing returns in legacy segments.
On the geopolitical front, the US-China tensions and related trade restrictions pose medium-term risks, especially for Alibaba's international ambitions. These factors could impact cross-border data flows and cloud infrastructure expansion. However, the data shows Alibaba's increasing investment in localized cloud services across Southeast Asia, which could mitigate some geopolitical exposure.
That's a key point. Diversification into new markets and product lines, like AI-powered logistics and financial tech solutions, offers tangible upside, but requires disciplined execution. Alibaba must manage working capital carefully to fund these initiatives without jeopardizing liquidity, especially in a volatile macro environment.
In conclusion, Alibaba's strategic risks are real but manageable with a clear transformation roadmap. The opportunities lie in leveraging AI and cloud to unlock new revenue streams and operational efficiencies. For investors and management alike, the focus should be on balancing short-term risk mitigation with long-term value creation through innovation and selective market expansion. When evaluating Alibaba's position in the e-commerce sector, the data clearly shows they remain the market leader by a significant margin, controlling roughly 55% of China's online retail market. However, their growth rate is slowing compared to emerging players like Pinduoduo and even JD.com, who are gaining traction with differentiated strategies focused on lower-tier cities and integrated logistics.
That's right, Shekhar. If we look at cloud computing, Alibaba Cloud holds about a 30% market share domestically, leading Tencent Cloud at around 20% and Huawei Cloud in third place. Importantly, Alibaba's cloud revenue grew 12% year-over-year this quarter, outpacing peers who reported single-digit growth. This shows Alibaba's continued innovation and investment in cloud infrastructure and AI-powered services are paying off, even amid regulatory headwinds.
From a CEO standpoint, sustaining leadership in e-commerce while pivoting aggressively into cloud is a delicate balancing act. The e-commerce segment is maturing and increasingly price competitive, so Alibaba's investment in logistics and AI to improve customer experience is crucial to defend market share. Meanwhile, cloud growth is capital-intensive and competitive, with global giants like AWS and Azure also eyeing the Asia-Pacific region. Execution discipline and clear strategic prioritization are key to avoid overextension.
Indeed, the recent quarterly results illustrate that tension perfectly. Alibaba's revenue in e-commerce declined 3% year-over-year, but cloud grew 12%. This shift aligns with the broader industry trend where cloud is becoming the primary growth driver. Alibaba's ability to leverage its e-commerce data and AI capabilities to create differentiated cloud offerings could be a sustainable competitive advantage versus peers.
Another factor is innovation capacity. Alibaba's increased R&D spend, up nearly 15% this quarter, is focused heavily on AI integration across cloud services and supply chain automation. This R&D intensity surpasses competitors like JD.com, which invests more conservatively. This commitment to innovation is essential to maintain technological leadership, especially given the rising competition from both domestic and international players expanding in China.
To wrap up, from a strategic viewpoint, Alibaba's competitive dynamics demand relentless focus on operational excellence and agility. They must continue refining their ecosystem, balancing near-term margin pressures with long-term growth in cloud and AI. Leadership will need to navigate regulatory uncertainties and competitive risks by doubling down on innovation while optimizing capital allocation. For investors and strategists, this means watching not just top-line numbers, but execution on strategic pivots in a complex, evolving market.
To wrap up, Alibaba presents a resilient financial profile despite near-term headwinds. Liquidity remains robust, with RMB 110 billion cash on hand, while steady operating cash flows support ongoing strategic investments. The margin compression we see this quarter, roughly 200 basis points, is a deliberate trade-off as Alibaba scales AI, cloud, and logistics capabilities, setting the stage for sustainable, long-term growth. Operationally, stable working capital metrics underpin this transformation without sacrificing financial flexibility.
Building on that, the evolving regulatory and market environment continues to shape Alibaba's trajectory. The shift from volume-driven e-commerce growth to investment-led cloud and AI innovation marks a fundamental regime change. While risks from regulatory uncertainty and geopolitical tensions persist, Alibaba's strategic focus on localized cloud expansion and diversified growth vectors provides a meaningful buffer. Investors should watch closely for execution milestones and margin stabilization as key indicators of progress in this new phase.
From an investor and CFO perspective, the key takeaway is disciplined capital allocation combined with operational agility. Alibaba's ability to maintain strong cash conversion and working capital discipline amid heavy upfront spending is critical. The path ahead demands balancing margin pressures against growth investments, navigating regulatory complexities, and defending market share. For those looking at Alibaba strategically, it's about patience and precision, backing a proven leader that's evolving thoughtfully rather than chasing short-term earnings spikes.